Hey guys, welcome back to the channel. Today I'll be analyzing quarterly returns and trying to figure out if we can find some patterns. So a few days ago I saw a report that contained a table, and that table gathered all of the quarterly returns for the S&P 500 and focused on drops below negative 10% for any specific quarter, and then they compared the performance a quarter later and 1 year later. So I'm going to try and replicate that, and with the script you can analyze any ticker you want, and I'll go over some examples as well. So I designed the script to not only focus on drops, we can also view rallies for any specific quarter, and it will also return the performance a quarter later and a year later. So all we have to do is require some packages, and here we're going to assign a ticker. So we'll focus on the S&P 500 index, and we're going to go ahead and call the data from Yahoo Finance. The next thing we'll do is we're going to return the quarterly return on the adjusted closes. All right, so now that we have our quarterly returns, we're going to go ahead and use this function where we're going to pass in those quarterly returns along with a threshold. Now the threshold can be positive if you want to get the rallies, and negative if you want to get the drops. So for example, if I insert a threshold of negative 0.05, that will return all the quarterly returns that drop below negative 5% for any quarter, and it will return a table with how much the S&P 500 dropped within that quarter, along with the performance a quarter later and a year later after that drop. So if we open up this function, here we gather whether or not we should return the drops or the rallies. So after we subset our performances and save it into this variable called temp, I'm going to get the return 1 quarter after and 1 year later as well. We're going to go ahead and convert these as a data frame, and we're going to go ahead and return the index and the quarterly return that meet the threshold criteria, along with the performances and the index a quarter later and a year later. So very straightforward function. I'm going to go ahead and minimize this function, and I'm going to go ahead and run it. So here I'm going to call in this function. I'm going to pass in the quarterly returns, and my threshold will be all those times that the S&P 500 dropped below 10% for any quarter. We're going to save it in QStat, and we're going to go ahead and take a look at QStat. So the first two columns focus on the actual drop. So here in 1929, in the very last quarter, we had a drop of close to 30%. The performance a quarter later was a positive 12.5%. And a year later, we had a drop of 29.31%. So now I want to take a look at the win percentage for the 1 quarter and a year return. So in other words, if we were to use this as a signal, how many times would we have won holding a quarter later and a year later? So we're going to go ahead and print that out into the console by running these two blocks. All right, so if we were to hold 1 quarter after the drop, the winner percentage was 64% and close to 75% for a year later. The average return for holding a quarter later was 6.14% versus a 15.2%. So a little bit of a higher percentage win, and the average return doubles if you hold a year later. So now I'm going to use the dates from my table and the returns to convert these as an XDS object, and I'm going to go ahead and plot the results. So if we take a look at the graph, so the green line are the quarterly returns for the S&P 500. The red line is holding the S&P 500 a year after the big drop, and the black line is holding the S&P 500 a quarter after the big drop. So using a 10% threshold, as you can see, doesn't get that very many signals, but holding a year later after the big drop is not too far off from holding the actual S&P 500. Now let's take a look at an example of when the S&P 500 rallies more than 10% for a quarter and see what the returns look like a year later and a quarter after. So let's go back to our script here. All I'm going to change is I'm going to flip the sign here on the negative 10. I'm going to rerun QStat. We'll take a look at the table. So all of these quarterly returns are greater than 10%, and here are the returns a quarter later and a year later. So now let's take a look at the win percentage and the average returns. I'm going to run this block again. So our win percentage for holding a quarter later is 75%. So that means that typically the S&P 500 continues to rally, or at least has a positive return a quarter later after a big rally, but the average return is pretty low, which is 3.5%. Holding 1 year later is close to 75% as well, and the average return is 9.79%. Now let's take a look at the plot. So we're going to go ahead and plot these. So let's take a look at the plot. So our drawdowns are a little bit less than using the negative returns, but it also cuts our performances, and also the spread of holding a 1 year later versus just holding the S&P 500 seems to have widened, since our average return is a little bit lower, but still positive nonetheless. So now let's take a look at the performance using a different ticker. So let's go back to our script. Here I'm going to be using the IWM, or the Russell 2000 ETF. I'm going to go ahead and get the data and convert the adjusted closes to quarterly returns. I'm going to go ahead and return the drops of negative 10%. So now let's take a look at QStat. So here we only have 9 observations, all pretty significant drops. If we exclude the very last observation, since this quarter hasn't actually closed, we only have 1 observation for both the quarterly and the year returns that return negative after a big drop. So now let's take a look at the win percentage. So we'll go ahead and rerun this block. Alright, so for the win percentage, we see that we have close to 80% for both the quarterlies and the 1 year. It would be a little bit higher, but since we include that very last observation for the most recent quarter, we get a slight drop in the win percentage, but we see that the average return is a little bit higher for both the quarterlies and the 1 year later. So now we'll go ahead and plot these along with the benchmark. So I'll be running this block. Now let's take a look at the plot. So as you can see from the graph, holding a year later after a big drop on the Russell 2000 ETF is pretty much on par with holding the actual ETF without any substantial drops. As you can see from the drawdowns, we still get a positive return if we hold a quarter later, but the returns won't be as high as holding a year later. Well guys, this concludes the video. You can go ahead and analyze any ETF or stock that you might like, along with changing the thresholds. I'll go ahead and leave a link down in the description area where you can find the script. Please subscribe to the channel if you haven't done so already. Thank you so much for watching, and I'll see you guys in the next video.